Hello learners, welcome to the course on Essentials of Financial Management. Here in the journey where we have discussed so many important concepts of finance, we are into the last leg of discussing the dividend policy of the firm. We already discussed that there are three important decisions of a finance manager. One, the financing decision, second the investment decision, and the third the dividend decision. And in the discussion that we have so far, we have seen that the two important theory propounded by the Walter and the Gordon has been successfully proven that the relationship between dividend policy and value of the firm exists, that there is a relationship between the dividend policy and the value of the firm. But against this proposition, today we shall discuss another theory which says that the dividend policy do not affect the value of a company. This is a model given by the Modigliani and Miller, and which is better known as the irrelevancy theory of the dividend. In this journey, we shall cover the proposition of this model, the assumption on the basis of which the model has proved it, the formula for calculating the market price of the share, followed by a practical problem, and finally, we would also analyze what are the merits and demerits of this model. Let us start with the concept of irrelevancy theory. What do we mean by irrelevancy theory? This model developed by Modigliani and Miller argues that dividend policy does not affect a firm's market value or its cost of capital under perfect market condition. Here it is important to discuss what is perfect market scenario. Here there are certain assumptions of perfect market where it is believed that all the investors are rational, the information is flowing free of cost, there is no transaction cost, and so on. So, here in the perfect market condition, the theory says that the investors would remain indifferent between dividend and the capital gain as the form of return. The basic premise behind this model is that the firm value is determined not by the payment of dividend, but it is determined by the investment policy and its earning capacity. So, the theory would also look at the dividend decision as passive residual decisions, which says that the financing choice made after the investment opportunities should be considered for determining the value of the firm. What is dividend as a residual decision? So, according to this theory, dividend basically is a financing decision. What is a financing decision? Where the company decides where from to raise fund and in what amount. So, they consider that dividend is nothing but a financing decision, which is primarily conditioned by investment opportunities. So, in their theory, they have tried to establish that the principal desire of an investor is to earn higher return on their capital. So, if a firm has some good investment opportunity which is giving good return to the company, it is advisable for the investors to have a preference for retention of profit rather than receiving the dividend. So, that is how the theory maintains that investors are indifferent between dividend and capital appreciation, as both ultimately affects the shareholders' wealth under the perfect market condition. Now, according to this approach, dividend policy does not affect the value of a firm, and therefore, it is of no use or it is of no consequences as far as value of the company or value of a share is concerned. Then how the value is determined? They say that the sum of discounted value per share, after dividend payment is equal to the market value per share before dividend is paid. And that means it is the earning potential and investment policy of the firm rather than the decision regarding payment of dividend or distribution of earning that affects the value of the firm. Now, let us see how M, Modigliani and Miller have given the proposition before they have actually came out with the formula. So, the first proposition is that when a firm needs to finance new opportunity, the total value remain unchanged regardless of dividend policy. That means, V, that is the value of the firm, or that is nothing but the value price of the share, that is P0 is nothing but the price of the share multiplied with the number of share outstanding, and now which in turn is equal to in bracket ND1, that is the dividend paid to the existing shares, plus NP1, that is the price of the share, divided by 1 plus K, that is the capitalization rate or the discounted factor. So, this is the first proposition which says that the value of the share is equal to the discounted value of dividend paid to the shareholder and the price of the shares which is outstanding for a given point of time. Now, the second proposition is that if the firm issues M, that is represented as new shares to finance investment, now the equation would be like NP0, that is the price of the share or the price of the company is equal to ND1 plus MP1 again divided by the 1 plus K. So, the total amount of fund raised by the issue of new shares in investment program is equal to what? It is the new shares issued by the company and their value. It will be equal to the investment opportunity minus the difference between the earning of the company and the dividend paid. So, that means the company can get the same value if it is going to raise new shares in the market to finance the investment opportunities over and above the earning which is already available for the investment. Now, just look at the meaning of the different term in our equation. MP1 is the total amount of fund raised by issue of new shares. I1 here represent the investment that is required by the company in order to improve the earning in future. X1 is the total amount of net profit available during the period. Now, through a mathematical derivation, the has demonstrated that the total value of the firm is equal to the capitalized value of the expected future earning and which is not affected by dividend decision. Now, so as a result, he has also shared the formula for determining the value of the firm, which is nothing but the discounted value of this dividend payment and the discounted value of the total value of shares outstanding at a given point of time. Let us see here V is the total value of the firm, N is the number of shares outstanding, P0 that the share price that we want to calculate for the future. P0 is the price per share that at time 0, that means the beginning of the year. D1 is the dividend per share at the end of the period, that means when company has obtained some profit and it has paid dividend, it would be represented as the D1. P1 is the price per share at the end of the period. So, whatever company does, whatever impact it would be having on the price of the share would be represented by the P1. K is the required rate of return or the cost of capital. So, here we can say that the formula has depicted that the present value of all share, that is NP0, that is the total number of shares multiplied by the respective prices, is equal to the present value of all dividend plus the present value of all shares at the end of the period discounted by the required rate of return. And it is very logical to accept this fact that any shareholder would invest their fund in any company because of two reasons. Number one, he would be expecting the dividend from the company, and secondly, he would also be receiving, he would also be expecting some appreciation in the price of the share, which is better known as the capital gain. So, capital gain and the dividend payment are the two important pillars for determining the value of any company at any point of time. Now, the step 2 is the proposition where the model has tried to calculate the number of new shares that should be issued by the company for financing the new investment, and this can be obtained where using the formula, that is NP0 is equal to ND1 plus MP1. Here you can see that the N has been replaced by the M, and here M is the new shares which has to be issued by the company in order to finance the new investment opportunity. So, we can explain it like numerator now includes MP1, that is the total number of new shares that will be issued at the end of the period, and which also reflects the fund raised by issuing new shares to finance the new opportunity. Now, let us move on to the step number 3, where we are going to substitute the formula for finding out the MP1. What is MP1? That is the number of new shares to be issued by the company, can also be calculated by finding out the investment requirement or the total investment need to be made by the company minus the difference between the earning of the company and the dividend paid by the company. So, here just try to look at the explanation for various variable in this equation. MP1 is the total amount of fund raised by issuing new shares. I1 represents the total investment required during the first period. X, as we have already explained, it is the total earning available with the company. That means, whatever company has on its investment is the X1, ND1 is the total dividend paid to the existing shareholder. So, this equation shows us that the amount needed to be raised is nothing but the gap that exists between the total amount of fund required and the amount of fund retained in the business, that is X minus ND1. So, the difference between the earning and the dividend paid is what? It is the retained profit which is now available for the investment in some projects. Now, the step 4 would give us the key insights from the proposition, where the total value of the firm, that is represented by V, would remain unchanged regardless of the dividend policy, because any funds not retained, that is paid out as dividend, can be replaced or exchanged by issuing new shares. This is a key result from this particular model, which has anyhow proved that dividend policy is irrelevant for determining the value of the firm. So, in essence, we can conclude that whether the firm pays dividend, whether it pays high dividend or low dividend, it can finance investment by issuing new shares. So, the amount company has paid in the form of dividend, the equal amount can be raised from the market by issuing the new shares. So, as a result, the value of the company would remain unchanged, and that is the doctrine of irrelevancy of dividend policy under certain theoretical condition. Why I am saying theoretical condition? Because just like the Voltaire and Gordon, the Imam theory has also made certain assumptions on the basis of which they have been able to prove that yes, there do not exist any relationship between the dividend policy and the value of the firm. So, first assumption is that it is a perfect market. that exist where all the investors are rational. What do we mean by rational investors? Rational investors are one which are very well aware about the relationship that exists between the variable, and who are aware that what kind of decision whether to purchase a security or to sell a security can be made with great amount of accuracy. Then information is available to all at no cost. There is no transaction cost, which has been further assumed by the theory, and the theory also assumes that there exists no transaction cost or flotation cost, and there is no group of customers, there is no group of investors who can alone influence the market value of the share. Taxes do not exist, and we can also say in addition to this that there is no difference between the capital gain tax and the tax that an investor has to pay on the income received in the form of dividend. The firm's investment policy is well planned and fixed for all time to come, and there is no uncertainty as to future investment and the profit which will be earned on the further investment made by the company. So, with these assumptions, the theory has given certain formula for calculating the value of the firm, where initially we find that the V is equal to the discounted value of dividend and the share prices. Further, the share prices is equal to the dividend and the newly issued share discounted at their capitalization rate, and finally, it has also given a subsequent equation where the new shares issued by the company would not have any bearing on the valuation of the company. So, let us find out the final formula given by the Modigliani and Miller, assuming that there is no external financing being used by the company, where P0, that is the price of the share, is equal to the D1, that is nothing but the dividend expected at the end of the year. P1 is the price that the shareholders expect to prevail in the market, and K is the cost of capital. Now, the same can be understood with a practical problem. Let us look at the case of XYZ Limited. This is a company which is having a capitalization rate, was the cost of capital as 10%. The company is currently owning 50,000 shares, and the worth of each share is rupees 100. So, can we find out the valuation of the company? The 50,000 multiplied by their current price, which is rupees 100, gives us the value of the company as 50 lakhs. Now, further company is contemplating or planning to declare a dividend of rupees 5 per share. So, at this moment company is thinking whether to pay rupees 5 per share as dividend or not to pay, and for this company is also having net income in hand to the extent of rupees 5 lakhs, and if the company pays dividend of rupees 5 per share, it comes out to be 2,50,000. So, if from an earning of rupees 5 lakhs, we pay 2,50,000 as a dividend, company would be left with 2,50,000 as the retained amount. Now, let us look at the further story. When company is proposing to make a new investment to the extent of rupees 10 lakhs, we have to calculate the price of the share according to model with the situation when the dividend is paid to the extent of 2,50,000. So, can we calculate what is the fund available with the company after paying dividend? it is 2,50,000. I hope you are clear. And what would be the further required capital? So, total requirement is for 10 lakhs, amount available after paying dividend is 2,50,000. So, there will be a requirement for 7,50,000. Now, we can show you with the further calculation. So, at step 1, we should calculate the value of XYZ Limited when the dividend is paid. Now, in order to find out the price per share at the end of the year, we would take the help of formula where the price of share is equal to this dividend plus the price discounted to their capitalization rate. Here, what is the current price? It is rupees 100. What is the dividend payment planned by the company? It is rupees 5, and P1 is something that is to be calculated based on this formula, and the capitalization rate is clear, it is 10%. So, if we put the value in our formula, we get as rupees 105 to be the price per share at the end of the year. So, if company wants to calculate the price at which the shares are going to be issued after paying the dividend, so as the capital of the company remain intact, the capital base remain intact, the price is going to be 105. Now, let me further elaborate as what is the amount required for new financing. It can be calculated by finding out the difference between the two important variables. Number 1, what is the total investment required? Second one is what is the amount available in the company after paying dividends. So, total amount required for further investment is rupees 10 lakhs, and the gap between the earning and the dividend payment is 2,50,000. So, if we subtract 2,50,000 from 10 lakh, we now estimate that it is the 7,50,000 rupees which need to be arranged by this company anyhow if company wants to make investment in this new projects in hand. Now, the second step is to calculate the number of shares to be issued in order to fulfill the financing requirement. Now, we have seen that company needs 7,50,000 rupees to finance this new projects, and the price at which it can raise it rupees 105. So, we can easily calculate by dividing 7,50,000 by rupees 105, and here we get the number of share as 7,143 approximately as the new shares to be issued by the company. And it is the final stage when we have to prove according to this model that whether the value of this company will change after this whole exercise or it will remain unchanged as per the theory. Now, the value of the firm can be calculated with the help of this formula. NP0, that is the price of the firm, is equal to N plus M, that is the existing number of shares to the new shares total. From this we should also add P1 minus the difference between the investment opportunity and the earning available with the company, the whole discounted at the capitalization rate or the cost of capital. Now, when we replace the formula with the figures in our question, let me tell you very slowly, this 50,000 is the existing number of shares, 1,50,000 is 1,50,000 divided by 21, that is the 7,143 is the new shares, and the price at which both these shares can be issued is 105, and the another part of this equation shows us the difference between the amount of capital needed to fund this new projects. and here we get as 55 lakhs divided by the cost of capital, that is nothing but the discount factor. We have been able to solve that it is the value of the company which comes up to be 50 lakhs. And if you compare this with the value before paying dividend and issuing new shares, it was also 50 lakhs. So, here the model has proved that the value of the firm remains unchanged whether dividends are paid or not. So, let me quickly share with you the working of this formula. Initially, company has 50,000 shares, I hope you remember it. Now, the number of new shares that need to be issued by the company can be obtained by dividing 7,50,000 by 105, that is the current price, and here it gives us the number of new shares to be issued as 7,142. So, what would be the total number of shares after this exercise? It is 57,142.86, and we know that these number of shares can be 57,142.86 shares current price is nothing but 105. So, when we multiply the total number of shares with the price, that is 105, the value of the company comes up to be 60 lakhs. And from this, if we want to reduce the capex that company is going to finance from outside financing, sources, it is 5 lakhs, because 5 lakhs is already available with the company. So, total amounts come out to be 60 lakhs minus 5 lakhs as 55 lakhs, and if the same value is discounted using the cost of capital, we get 50 lakhs, which is nothing but the value of the company, that was 50,000, the number of shares multiplied by the price of the share, that was 100 at that time, is giving us the value of the firm as 50 lakhs. So, hence the model has proved that whether the company pays dividend or do not pay dividend, the value is not going to get affected by this exercise. Now, it is time to see whether the model is true or it can be used in practical scenario or not. So, let us find out. The model can be criticized for the certain reasons, but yes, it is going to prove that the investors are risk averter, they have a desire for current income, information content are very important, and sale of additional stock is possible only at a lower price. Capital gain tax rate is different from that applicable on the tax rate on dividend, and transaction costs do exist, and investors behavior are sometime or most of the time is irrational. So, let us find out if there exists any merit of this model or not. Yes, it has laid down a very strong theoretical foundation, where with the help of formula it has proved that it is the value creation which is more important, rather deciding as how the distribution of earning is to be done by the company. Then companies also feel that investors are not always rational, as it is based on the theory of perfect market condition, which may not hold true in a real life situation. So, as a result, we can criticize this model on various ground. So, number one, the unrealistic market assumptions, which assumes that market is perfect, whereas it is not. The model has also believed that every investor has the access to the information equally, but again that is not something which we can accept. The information disparities between the management and investor always exist in the actual market, and that is how there is a scope for improving the profitability or improving the return for the management, because they have got access to more insider information. the tax consideration has been ignored in this model, and whereas the fixed investment policy assumption is also very unrealistic, because the management may keep on changing their investment policies as and when opportunity exists or they appear in the dynamic business environment. The certainty assumptions is also very doubtful, because investment and profit they can never remain predictable in the condition which we come across in the real life scenario. The market frictions, including the transaction cost and the flotation cost, have been overlooked, and also a very important theory which is known as signaling effect, which believes that the dividend announcement is more important than the earning announcement. So, we should give due consideration, due attention to the dividend announcement, and as a result they would always affect the market price and valuation of the firm. But somehow the MM model has proved that the dividend payment is of no consequence as far as the valuation of the firm is concerned. So, with this we come to an end of this model, and hope that though it is very complicated to understand and also to apply in the real life situation, we have to these two people for actually bringing out the relevance of the dividend policy with the valuation of the firm, which has been ignored in this particular model. So, with this we come to an end. We hope you liked it, you enjoyed it, and you have understood. But yes, if you have any queries or questions, we would be available, and you can write me back about any of the doubts if you have regarding these discussions. So, thank you for your patient hearing and also for your valuable time. Thank you.